Oh, there you go. Never mind. Heather's on it. She already got us recorded. Okay, perfect. We are going to get started. I love to do this every year. This is the market update. I just first want to give a little disclaimer that this data was pulled from the KW Research Center, not from me. And there's other different factors that go into all the data that's pulled, but this is actually one of my favorite things to watch and study and go through every year. And truthfully and transparently, this year is very interesting. So it's going to be good for us to get to go through this and for you guys to get to know this. Would love, while we're still admitting some people, if you could maybe just type in the chat what city you are in, what city you're in, and is your current market busy, slow, or normal, would you say? So where are you? Where are you? And are you busier than normal, slower than normal, or just normal, would you say? And I'm anxious to see kind of what's happening in everybody's different markets as we walk through this together. Let me make my slide a little bit bigger. Ruth is on Virginia. Yep, starting to slow a little. Prices coming down a tad. Okay, interesting. Yep. Raleigh, Annabelle slowing down. Yeah, Columbus, Dublin, slower than normal, starting to slow. Normal, but slowing some. Yeah. Yep. Kim's tad slow. Marysville still pretty busy, but things, yeah, totally agree. Yep. Okay. So overall, starting to slow. I will say, just for you guys who are maybe newer in the business, those of you who have been in the business for a while will know this. And actually, just had this conversation this morning with one of our top agents in Kentucky. He said, I pretty much write off July and August every year, knowing that everybody's on vacation, everybody's getting back to school. It always kind of dips down, and we're going to take a look at some of those trends today. But I'm going to go through and we're going to start with a market update. I have a lot of notes to share with you guys, and I'm happy to send these slides afterwards. Also, we're going to be dropping in the chat a few resources for you guys. And one of them I got from a dear friend of mine. His name is Taylor Davis, and he is a financial and wealth manager in Kentucky. Super smart, great guy, great friend of mine. Just actually, believe it or not, I have his book right here. Just wrote a new book called Parable for the Republic. Super great read. If you're in one of my offices, he's going to be coming to us at the end of the year, and you're going to get a copy of his book. So don't buy one, but you'll get it as a gift from me later on in the year. And he's great. But anyway, he gave me a great resource about investing in an election year, because the one thing I want to start before we get into this and share with you guys is, obviously it's no shocker that we're in an election year, and truthfully, we're in a pretty volatile election year. I don't know that any of them are not volatile, but so things, can change. Anytime you're in an election year, it's a different year than the other 3 years. So I'm going to share a resource with you guys on that towards the end. And then also we're going to talk a little bit about that, but I'm going to start with the US economy, which is what Gary always starts with. So first slide is GDP, gross domestic product. So GDP has a lot to do with real estate. And I'll explain to you kind of how this looks, but if you look, this is over an annual basis. So the actual definition of a recession in our country is 2 quarters back to back of a negative GDP. I actually think I might have this broken down quarterly. Yep, I do. So as you can see, back when we kind of were fresh into the pandemic, we had 2 really negative quarters of GDP. And typically before the government will declare a recession, all of y'all are the ones who feel it first. We feel it in real estate first, because things start to slow, people stop buying, people stop putting their houses on the market. We always tend to feel it first. You can also see this happen again in 2022, where we had 2 quarters back to back of a negative GDP. So right now, it's nothing more than just people are still spending, you guys. And it would be helpful if everyone would stop spending, but people are still spending. We want to see 2.5% growth. 2 is really, really good. but we've just been higher than that. If you look even in 2023, the reason that we're in the pickle that we're in right now is because we got up to 4.9. As it sits Q2, we're at 2.8. So getting closer to where we need to be. But average, by the way, is 2.1. And like that's right there where it should be. That's right where we want it to be, where we feel like things are good. Okay, this is the bad slide that I'm just going to go ahead and get out of the way, and then we'll go to the rest. And I'll explain why. I've got 3 different scenarios towards the end that are super good and very, very useful. You guys can actually probably use those a lot with your clients. But this graph shows the probability of a recession. And remember, a recession can mean a lot of different things. We can have a housing recession, we can have a banking recession, we can have a global recession, we can have a Federal Reserve recession. Probably there's all different definitions of recession. But the bad news is, based on the Treasury, the probability is the highest that it's been since the 80s that we will have some sort of a recession. So that's just, let's go ahead and just get that out there. However, again, I'll explain to you what that means later, but just remember, and this is what Gary shared with us, you have to have a recession to have a boom. And quite frankly, we've been so high that it's, the saying, what goes up must come down. Like it's going to slow a little bit, and we can all expect that. And that's going to be normal. But the probability right now, according to the Federal Reserve, is that the recession probability is high. And again, we'll go through that. But all of these factors do play into this. So the first one is unemployment. Right now, anything below 4%, by the way, is good when it comes to unemployment. That means that also, though, people are moving jobs. So just because we have a lot of people right now in our country moving jobs. So just because they could be unemployed for a time period, it could be because they're moving to a different job. So they're looking at doing something different. Right now, unemployment was, let's see, if you look, we were high at 8.1 back in 2020. We still kind of were high in 2021 at 5.3, but we're starting to get back to where we need to be. Let's see, right now also, right now he said if people would spend less money and kind of like bring down their spending a little bit, that could normalize a recession coming. We really don't know. But this next slide, here's unemployment by month, just for those of you that want to see it. Again, we'll send it. This one is interesting to me. So this is the unemployment job openings currently through June of 2024 across the United States. And as you can see, the orange line is actually the job openings that we have. And then the kind of tealish line is unemployed people. So we have about 2 million more job openings than we do unemployed people currently, which is why, if you like here, I'm in Charleston, South Carolina this week, and still in Charleston, like sometimes some of you that are on from Charleston, you might know this, like we'll go places and they'll say closed early today, like low staff, or like, due to a staffing problem. And so like you still experience that sometimes in smaller towns too, I think. But this is why there are 2 million more job openings than there are unemployed people right now. And maybe that'll change. Here's the biggie, inflation. And obviously, the interesting thing to me is that we all are still spending when inflation has been the highest that it's been in years over the last little bit. So Gary kind of said, when a recession comes, does it change what actually happened to us with higher inflation? We're still above the target line. I mean, the target line for inflation is to stay right at 2%. As you can see, it goes up, it comes down, it goes up, it comes down, but it's been way up since 2020. It just spiked, right? Everything just went, especially energy and food, went through the roof. And so you can, the orange line, by the way, is energy and food, and then the teal line excludes energy and food, but most of you know how expensive food has been lately, especially if you're like us and you have teenage boys that eat 24/7. But so right now we're sitting at right about we're projected, we're sitting still in the 3s, but we're projected hopefully to get down to 2.7, 2.9-ish. But we're just still feeling that things are expensive. And are you guys feeling like things are still expensive? I do. I definitely feel like things are still expensive. Yeah, so we're feeling that. So we really do need this to come down because it does affect home sales. Here's inflation monthly, if you want to see the monthly. And then this is interesting too, before I get into home sales. I included this one because I really like these slides. So this shows us actually what prices are falling right now. So the price of smartphones, used cars and trucks. If you remember a couple years ago, used cars were like through the roof. And now used cars have come down by 10%. Toys, games, hobbies, televisions, airfare, thank goodness, praise the Lord, is starting to come down just a little bit. It got completely outrageous. So airfare is coming down just a little bit, 5%. Furniture, you can see so on. Gas, a little bit down. And then next slide is things that are rising. And this won't probably surprise many of you, but motor vehicle insurance is definitely on the rise. Anything in the health service, hospital stays, hospital services, dental services, healthcare at home is major on the rise. Gary says one of the hardest spots to be in financially. Also, by the way, college, like school, on the rise. If you have college kids and elderly parents that you're taking care of at the same time, that's like one of the roughest financial spots to be in, because those two things are just, the prices are raising astronomically. I actually laughed when I went back through this morning. Admission to sporting events. We're coming back to Kentucky for a couple weeks, and we're going to go to the Kentucky-South Carolina football game next week. And I paid more for those tickets than I have like ever. I'm like, what is happening with football tickets? So real estate industry. Okay, these are some of the important ones that I want you guys to pay attention to. Everyone is wondering what home sales are going to end at in 2024. So as you can see, we had a great run, a great few years. 2021 being the best year in a really, really long time, since like 05, 06. And that was when we had 6.1 million home sales in the United States. 2022, we went to 5 million. Last year, we really felt it. Last year was one of the lowest years that we've had since 08, and we closed at 4.1 million. So here's the thing on home sales. They're projecting right about the same as last year. So right now, projections are on track to be right about 4.2 million homes sold. However, we could go as low as 3. All this is going to depend on what happens in the last quarter. And again, we're in an election year. We have a lot of volatility with rates. I mean, we're hoping they'll continue to come down. I do think, most researchers do think that they'll come down a little bit. But if we went into some crazy, recession, we could go as low as 3.8 million homes sold. However, if rates continue to come down, we will see 4 million plus, which is what they're hoping, what they're projecting, that we can get to right around that 4.1, 4.2. We just really, really need a strong Q4. We need a strong Q4. And truthfully, the economy has kind of halted home purchases. That's why you guys are feeling like things are a little bit slower right now. And so it's going to be interesting to see how this kind of pans out. Here it is by month, if you want to look at it this way. And we only have through June of 2024 on this, because these stats drag a little. It takes us a little bit longer to get some of these, to get them accurately, but you can see we're trending a little less than 2023. The purple lines are 2023 by month. The teal are 2024. So take June, for instance. We're just trailing a little bit compared to last year. So if we can get rates to drop to 6, would be awesome. A little below 6 would be even better. We're definitely not going to see like the 3s or anything like we did before. Most analysts will say that we'll never see in our lifetimes, anybody on the Zoom, no matter how old you are, in our lifetimes, we'll never see rates that low again. Here's home prices. So if we can get the rates to drop, then obviously this is going to play into this. So right now we're sitting at an average median home price right around $398,000 across the United States. If we were on the 4% trend line, meaning things were, trending just like we normally do, and a healthy trend line at 4%, the average price would be right around 357. So we're definitely higher than what the trend line is. It could come down, but we're staying right around 11% appreciation right now. They're saying we could get as low as 7%. on it. And so we're not going to get to that 4% trend line, but they're saying we could get to 7%. But the good news to me about this is that, and you're going to see this, like we're having more volume than we've ever had. So volume is high. It's just that units are dropping a little bit. So a lot of you haven't really felt that much of a skip or a miss in your GCI potentially because the volume has been high, right? But if volume were to come down and then we have a unit slowdown too, that's when we can really feel things. But right now we're above the trend line when it comes to home prices. Here's home prices monthly. You can see the opposite of the last slide in home sales. Home prices are actually higher than what they were in 2023. So if you look at June, 410,000 as opposed to 2024, 427,000 average median home price. So we're trending up on the prices. And all of that really, you guys, just plays off of rates, what exactly the rates do. Inventory. If prices go up, then homes will sit on the market a little longer. That's what this graph shows. Homes are sitting on the market a little longer in 2024 than they are last year. We've been having a lot of trainings, a lot of conversations around how to have price reduction conversations. Many of you are very familiar with price reduction conversations. Others of you have never had to have them before. And so if you haven't had to have price reduction conversations before, then now's the time for you to learn how to do that, because they are going to continue to sit just a little bit longer if prices continue to go up. However, Gary Keller would say to you that this is actually a good thing. Because it will produce more buyers, right? The longer that a home sits on the market, the more likelihood that you have to pick up more buyers, which we all want. For those of you that are in new construction or sell a lot of new build homes or represent builders, this is the new home starts graph. We're still way behind. We're about 1 million new construction homes a year behind from catching up to where we need to be. A lot of this was because, Heather will understand this, the price of lumber, as many of you guys know, and other materials just skyrocketed and went through the roof. And so that caused a lot of builders to halt and or build less than what they were building. We're projected right now to be about the same as what we were in 2022. Last year, we dipped down just a little bit. Gary kind of says the only actual solution of this is just going to be local solutions in local markets, and that's freeing up more public space to be able to build more. And also, I don't know, I'd love to hear this in the chat if you guys have thoughts on this, but starter home prices are like gone in new construction. It's really, really hard to find a starter home. That's to find a brand new starter home at a starter home price. So, one of the things that Gary mentioned, and Jay and Jason and the research team at Mega Camp, was if we could get some builders to come back in, find some land, and get some decent starter home prices back for new construction, that would be a game changer, and we would probably pick up and be closer to where we need to be with new home starts. Here is the new home sales and builder confidence. So as you can see, definitely down in 2022. They were down, new home sales. They spiked in 2020, but we're still a little lower right now than where we need to be with new home sales. And then on the right, you'll see the builder confidence index. A big part of that is because builders don't have as much confidence right now to go out and start a bunch of specs. So like they used to, like if you look back at 2020, when the pandemic started, the builder confidence went to a low. And so that's the problem that we're having now, is we're having to pick back up and try to catch back up to all the builders that were like, whoa, what the heck is going on? We're not going to take the risk. Let me see really fast in the chat. Blair, I heard DR Horton building starter homes 1,000 to 12, and even that's even crazy to me, Blair, because 1,000 to 1,200 square foot starter home, even 5-6 years ago. They were like 140 to 180, I would say, at least in Kentucky. I don't know about Central Ohio, but the prices have really gone up. But that would be great. To get back into that starter home price would be really good. Thanks for sharing that. So as builder confidence hopefully continues to creep back up, we'll be able to see more new home starts. Okay, So this is the slide that I always encourage everybody. Most of you, if you're in my office, you probably have this laminated somewhere. It's probably a little bit like a year old now. We need to give out new ones, but this is the slide that I would highly recommend everybody constantly having with you and having it laminated, have that in your as your propaganda in your back pocket to pull out when you're meeting with buyers. And the reason is because if you look, well, let me tell you this. This is what one of my favorite quotes Gary says. When in doubt, zoom out. Which what he means by that is get a bigger perspective. Like think from a bigger picture and look at the past. So when in doubt, zoom out. So if you're working with clients who are saying their rates are too high right now, or like, this is, and I'm going to show you why they're saying that on the next slides, and you guys are going to be mind blown. But if you have people saying their rates are too high, when you look at this, the historical average in the United States from 1972 all the way to 2023, the average rate was 7.74. That feels really high to the people who are sitting at a 2.5 or a 3 to 3.5% rate right now. It does feel high. But when you zoom out and look at the bigger picture, we're actually less than what most people had ever had a mortgage at. And if those of you that bought houses like pre the 2000s, you probably had higher rates. I think Gary said I think that's why this is on here. I think Gary said he bought his first house, I think 81, which was the rates were 16.63%. So then if you look the historical average, if we just take from 1990 to 2023, it's 5.98. So that's why in most people's minds, this is more of like a mindset thing. If we could hover around 6%, like that boosts confidence back up, and buyers are typically going to be okay with a rate around 6%. If you look right now, they are coming back down. When they gave us these just a couple weeks ago, we were at 6.5 that day. I don't know what they are today, to be honest. I haven't looked, but if we could get down just closer to that 6, that would be really great. And that will really change things. But this is the slide to me, you guys, that like everybody should have this, like slap your logo on there. And have this laminated to show to your buyers, because they just need to have a better perspective. Because truthfully, and a lot of you guys will understand this, the media doesn't understand this at all, and they paint the worst case scenario picture. And you can look at that from looking at the NAR settlement and what's happened with that, which I am going to touch on that just a little bit at the end. But it's clear with the NAR settlement that the media has no clue, and or they paint the worst picture. So, and remember, our clients, like, that's kind of what they watch. That's what they see. So it's our job as real estate professionals and as their fiduciaries, not just their functionary, but their fiduciary, to actually lay all of this out and give this. And yes, Jamie, I am sending out the slides later. Absolutely. Here, and actually, I'll just drop them in the chat too. So if you just hang on till the end, I'll drop them in the chat. Here's mortgage rates monthly. So July hovering right around 6.85. Again, I don't know if anybody knows what they are today and you want to drop them in the chat, that would be awesome. But I'm not 100% sure. But one of the things that I took away when Gary was talking about the mortgage rates, and kind of his theme throughout almost all of Mega Camp this year, was just, you have to do the work. He says there's an equal opportunity, but we live in an equal opportunity, unequal reward world. That's kind of a mouthful. Equal opportunity, unequal reward world. And the people and the agents who are doing the work, and they're providing the resources, and they're giving their clients perspective, and they're doing with it, they're the ones that are seeing, increases right now. We have several agents, you guys, whose business is up. And it's so awesome to watch, and they're doing the work. So Gary kind of said in a very Gary direct way, if you aren't hitting your goals, it's just simply because you might not be putting in the work like you used to, or like you need to be. And we can't necessarily let the rates be the excuse. However, you'll see we've got a little bit of challenges on the next couple of slides. Here's affordability. He just said, yes, it is an expensive time to buy right now, but truthfully, it just is what it is. So we have to be able to find the motivated. For those of you that have read the book Shift, in there, like, one of the number one key things is find the motivated, because there are still people that are, getting married, having babies in diapers, downsizing, getting divorced, people unfortunately passing away. There are still reasons why people need to move and people need to sell. And so it's our job to find the motivated, because here's what Gary said. It's always the right time to buy real estate when you buy it at the right price and you buy the right property. And then Jason Abrams said something, and Teresa Kinney, I don't know if she's on, but this was like mine and hers largest takeaway. And here's what he said. I'm going to type this in the chat. He said, you might be buying at this is so good. You guys should copy this. You might be buying at the top of the moment, but never at the top of the market, because the market in real estate is always going up. And if you look at the trends, that's so true. So you might be buying at the top of the market, but you're never you're never at the top. Hold on. But never at the top of the market. Here we go. Yep. Oh, it was J. Oh, it was in J's. Oh, thanks, Ruth. Okay, yes. It was the biggest one. Hold on. I'm just trying to, because, let me type this in here so you guys can have it. The market in real estate is always going up. There you go. Yep. This is a great script for you to give to your clients. Great dialogue. Sorry, we're not supposed to say script anymore. You might be buying at the top of the moment, but you're never buying at the top of the market, because the market in real estate is always going up. And those of you that are investors or have bought, like, the market's always going up. You're only hurting if you have to sell, and it's at a time that isn't a great time to sell. So keep that in mind. Sides per agent. This is less than what we would like to see. This is kind of wild, you guys. So the average agent in the United States this year, will close what they're projecting 5.6 sides annually. Now, there are some of you who do way, 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 way more than that. And then think about all the agents that do nothing or might do one. So the average is 5.6. However, the historical average is 10 sides. So if you are one of those agents that's feeling like you're, having less units or less sides than normal, this is why. We would love to see this back up to 10 sides per agent as an average, which would be great. But you can look at the top. I love how they break this down, how the KW research team does this. Between 2000 and 2007, NAR added 550,000 agents. So sides dropped from 13.5 to 7.5 per agent. When we had the last kind of bigger recession, which was a banking recession, remember, from 2008 to 2012, 330,000 agents got out of the business. And so sides per agent went from 6.9 to 9.3. Then if we look at the last, say, 10 years or so, they dropped again because 580,000 people got their real estate license or came out of escrow and came back to selling. So what affects the sides per agent and how you guys will feel it is all about how many agents are in the business, how many are getting out. Here's the market volume per agent. And this is the good news. We're in the third best year that we've ever had on volume per agent. So if you look in 2022, there were 1.58 million realtors that were a member of NAR. That was NAR agent count. That year, you can see we had one of the highest, we had the second highest volume that we've had per agent. And so last year took a dip, but this year is projected to come back up, and it should be the third best ever. So those of you, and honestly, my conversations with a lot of you that I talk to, your average sales price is up. Will you just actually, if you are willing to share, if you know that your average sales price is up this year over last year, or even over the last couple of years, will you just type like yes in the chat so I can kind of see? But most of you guys, I know, if you're in my offices, a lot of people, average sales price is up. And that's a good thing. Yep. Most of you. Yep. Awesome. Okay, here's the shocker. So I'm going to send these, but if you, or I'll drop them in the chat too, but you might, if you want to screenshot them, you can too. We're going to talk about the mortgages right now. 76% of mortgages in the United States, 76% of those homeowners have a rate of less than 5%. And I'm sure many of you have heard, why would I trade a 3.5 for a 6? Or why would I trade a 4 for a 6 for a 7? Or, whatever that conversation is. But you can see, that's a large percentage. 76% of mortgages have a rate of 5% or less. This is why we're feeling like it's a struggle to get people to move, because they don't want to trade their mortgage. Or their rate. This is another great slide, one of my favorite slides that came out of this. And this shows you right now that 33% of homeowners, so there's 86 million homeowners, by the way, right now, 38% of them own their home outright. Like 100% own their home outright. It's the highest percentage that we've ever seen in our country. We've never had that many homeowners own their home outright. which is incredible. And also that's a huge opportunity. I'll talk about why in a minute. Most of you know. And then 32 million, which is 38%, have more than 50% equity in their house. And if I asked you guys to raise your hand, I'm sure a large percentage of you would raise your hand that you have more than 50% equity in your home now over the last few years too. 24% have less than 50% equity. However, what this tells us is roughly 76% of all of the homeowners in America have more than 50, they at least have 50% equity in their house. So a huge opportunity for us. Top 110 in my market are 24 million and higher. Seems really low. Yeah. Yeah. And that's in Raleigh, I'm assuming, right, Annabelle? That's kind of ironic because volume is higher right now for us, especially in Columbus, way higher than what it typically is. But what I want you guys to think about here is even if, yes, Raleigh, okay, even if they're not willing or they don't need to sell their home, what are they doing with the equity that they have in their house? Like, are you changing conversations and or adding to your conversation with your database about them investing? I mean, we all know that the safest way to invest is real estate. It always has been, it always will be. And so with 76% having greater than 50% equity in their homes right now, like the question I have is constantly, and honestly, like Adam and I do, and we're asking ourselves that, like, we're just waiting until we can find a great deal, which I do think there will be lots that will come up, but what are they doing with the equity in their home? And are you guys even thinking about that? Yeah, here it is. Sorry, on a slide. 76% of homeowners have at least 50% equity in their home. This is huge. And this is why Dana's perception is that we won't have a crazy recession. This is why. If you remember, those of you who were in the business, I know some of you were, if you were in the business in 07, 08, 09, the reason we had such a recession is because nobody had any equity in their houses. They all couldn't afford what they had to begin with. And so we went into a banking, what we call a banking recession, and everybody got foreclosed on, or they had to short sell because they didn't have that. This will be the thing that will save us from a recession like that, which is why personally, my personal opinion is that we won't have anything even close to what we had in 07, 08, 09 era, which by the way, I got licensed in 06. So that was like, just a great time to get your license. Lori, did you too? Is that when you got licensed? Yeah, that's why I remember we were close to like the time frame. And so if you went through that, like the good news is I personally do not believe that we will go through that again. And this slide is exactly the reason why. People have equity and so they have options. Now, some people, and you guys, some of you may have gone through this. Actually, this is kind of how we bought our house that we live in right now. But one of the things that does affect this is some of these people, like maybe, say they're 75 plus in age, may have the equity, but they may not be able to access it because they might not have a job. They might be retired. They might not actually qualify to be able to get a line of credit or pull out the equity that they do have, which in some situations typically forces those people to sell. I don't think we have anybody from Canada on, but here's just one slide in case you're interested in the Canada market. Their sales are just up 6%, prices are only up 3%, and inventory is down. So they do have low inventory. Okay, so here's the 3 scenarios when it comes to a recession. And these are the ones that Gary gave. So the first scenario is no recession. Unemployment goes below 5%, interest rates fall to 6%, and we hit a little bit better than what we did last year in home sales and finish around 4.5 million. This scenario will be defined as by a resilient labor market, which allows rates to be increased before a recession sets in. The decline in rates will result in more home sales, which would be great, but the recovery will be slow in housing as rates take time to come down. So if we could get them to just keep going down, this would be the scenario number 1. Number 2 is that we have what's called a normal recession. Unemployment would be somewhere between 6 and 8%. So there would be a lot of job openings that more people would be moving into. Interest rates would fall rapidly to between 5 and 6%. And by the way, this is not a political statement because at this point I'm so over the election, I can't even talk about it. But if rates fell rapidly, then, this is what could happen because home sales would increase at that point, and we would go closer to 5 million homes sold this year in 2024. Historically, falling home sales lead us into recessions and rising sales lead us out. And that's just over the history. After 3 years of declines, the transition into a recession would trigger a more aggressive drop in rates from the Federal Reserve and stimulate the housing market to drive the growth of an economic recovery. So remember when I told you earlier that we always feel the recession before our country comes out and says we're in a recession. We also feel the recovery before others do because home sales start to go up. And then the last one, which is what I think will not happen, is an economic scenario number 3, and that's a banking recession. This is typically more what happened back in that 07-08. Unemployment gets between 8 and 10%. Rates would fall to between 3 and 4%, which like nobody is saying that is going to happen. And that would drop us to less than 4 million homes sold. Again, because of, let me just go back really fast. Oh, this doesn't move fast. Because of this slide, I typically wouldn't be, be very strong feeling and saying that I doubt this is going to happen. Hope it doesn't happen, but this would be when like the banking systems create a shock to lending. Home prices and home sales will fall. This is what happened in the Great Recession and savings and loan crisis, which is what we went through before. So those are the 3 options. I'll send you guys those. I feel like we're going to be between 1 and 2. And it's just kind of going to depend on how this year goes with the election. This is a great slide for everybody on here. And these are the methods of home purchase. It is the highest it's ever been at 89% that buyers want to use a professional real estate agent or broker realtor to purchase a home. So this is great news. Gary said, let me see what he said on this. Yeah, highest it's ever been. And he flat out said that even with the NAR changes, that this is not going to change. The buyers still want a real estate professional to help navigate and help protect them. So this is a really good slide. Now, here is the NAR settlement simplified. We have sent this out to our people so many times. I'm going to drop another link in the chat for you guys. But just so you know, I know all of you guys know this, but as of August 17th, the practices changed with the forms. They may not take effect until September 16th for non-realtor MLSs, although all of us are realtor MLSs, I think, unless you're on here and I don't know you. But that we're past this. So things did change. I'm going to share with you guys a couple other things too on this when we're finished, but here's just a couple things. You must use a buyer representation agreement before showing the home now. You must disclose the amount or rate of compensation that you'll get. Your compensation must be written into the agreement. You guys all know this. It can't be open-ended. You cannot receive compensation for brokerage services from any source for more than the amount or rate agreed upon. And you must include all of the broker fees, any commissions, anything is fully. Oh, we do have somebody on from Canada, Jim. He just messaged me. Jim, you're welcome. Thanks for being on. But everything is fully negotiable. And so we have to make sure that we are being transparent in all of that. Cooperative commission can no longer be on the MLS. We already know all of that. Sellers can still offer a concession to buyers in the MLS, and that concession can be used to pay the buyer's agent should the buyer choose. And then agents must disclose in listing agreements, buyer representation agreements, pre-closing disclosures that broker commissions are not set by law and are all fully negotiable. So all of those have been changed, and I would say most of everybody's forms by now. Curious, and that's it on the slide. So let me stop sharing really fast. I'm going to share a couple of things. Curious from you guys, and would love to hear any questions. I'm happy to answer any questions. We're actually going to end a little on time, but I have some things to share with you, so don't hop off yet. Curious though, are you guys like business as usual, struggling with conversations post the changes in the forms? Would love to hear anything you guys are coming up against. Is it business as normal? And let me put yeah, becoming more normal. Okay, yep, Erica said yeah. Okay, the first thing I just dropped in the chat for you guys is what I talked about from my friend Taylor Davis, and that's a guide to elections. This is more from an investing standpoint. However, I would definitely download that and read through it. The one thing that you can pull out of that I will tell you, I think it's great for real estate agents to know, is the 4-year term of any election of Yes. Okay. So anytime there's election year of the 4-year term, the actual election year always proves to be the most volatile, which isn't surprising to any of you. However, of the 4-year term, the year after election year, so for us would be 2025, is typically the best year out of the 4 when it comes to the real estate and when it real estate industry and the investment industry. And that's, you guys, you can see if you open that PDF, it's whether a Republican wins or a Democrat wins. It honestly doesn't matter. And the reason is because people are like, well, we're stuck with them for 4 years. So it is what it is. I might as well go ahead and do what I'm planning on doing or do what I need to do for my family when it comes to moving, buying, selling, investing, whatever. So, so that's good news for 2025. So definitely look through that and use that. And then the other thing, I'm going to go ahead, hold on one second. Let me drop the slides in here for you guys really fast too, just so you can go ahead and have those from today. And then I have one more thing. Actually, Heather, if you're still on, I might have you put yes, she is, I think. Hold on. Oops, hold on. Let me get you guys the slides really quickly.
I'm here.
Oh, okay. In a second, I'm going to see if you can drop that Eventbrite link into the chat because I have a really good training I want you guys to register for before you go. Okay, hold on. Why are my slides not showing? I've got the election year. Hold on one sec. Let's see. One sec. That's weird. Like my slides totally oh, here they are. Okay, that's why. Hold on one sec. Got it. Okay, market update. Let me drop these in there for you guys really fast. Documents. Market update. Okay, here we go. Okay, got it. Here are all the slides from today so that you guys will have. Oh yes, Kyle said, any chance to get them emailed? Yes. Heather, can we email these slides also to everyone who registered on the event? If you registered for this, I think we can. Can we, Heather?
Yes, I'll email if you registered on the Eventbrite link. If you did not register through Eventbrite, type your email address in the chat and I'll make sure to get it to you.
Perfect. Yes. Okay. That would be great. Thank you so much. Yes. Okay. Let me see. Lori said, not having many issues, but working on explaining to buyers. Yeah. I had an investor buyer say to me the other day, didn't need to sign anything because he's an investor. Yep. I have been hearing investors. That's not the first time that I've heard that. Business is certainly different and struggling, not just with clients, but also with other agents. Yeah. Yep. The compensation changes. And I will tell you guys, just to give you a little bit of off record, but insight from what I'm hearing, a lot of people are saying that this kind of might not be over, that there might be like a round 2 to all of this stuff. And it's because they do not want broker to broker. They don't want broker to broker shared compensation. They really don't. Their end game is for the buyers to be solely responsible for paying their agent, whether they choose to do that out of pocket or whether they choose to negotiate that in and ask for it. They want it to be negotiated at the time of the offer. They don't really want broker to broker compensation. And so with that being said, you know, a lot of people are, and I don't know 100% which way I feel on this yet, but a lot of people are saying that round 2 could be coming if people continue to pay cooperating commission to other brokerages, which just really blows my mind. But, you know, at the end of the day, I think we're at the mercy of a lot of these, and this is my personal opinion, and I'm definitely don't care to share it. It's these attorneys. We're in this like litigious time. And I mean, these attorneys are making out like millions and millions and millions. And these people in these settlements are getting like pennies on pennies on the dollar. So it's going to be interesting to see. But last news, and then I'll let you go early. I am very excited. I don't know if you follow this person on social media, but his name is Jared James. Heather just dropped the link to the Eventbrite. I have been trying to get Jared James to do a virtual event with me for a little bit, and he agreed. His schedule finally freed up. And so on September 26th, we're going to have a virtual Zoom. I anticipate it to be very packed. So and there is a charge, by the way, and it's just because he charges quite a bit for the hour. So it is $20. Yes, Annabelle, he is awesome. Like, I mean, honestly, I wasn't even reading the news when a lot of this was coming out. I was just going and following Jared and like watching his reels and seeing what he was saying. I had a pre-Zoom with him yesterday for an hour to talk about what we were going to talk about on September 26th. And Adam came out of his office and he was like, who was that? He's like, that guy is like on fire. He knows everything. And I was like, yes, he does. So it's going to be incredible. He is very intelligent. And to be honest, you guys, he's not really like one side or the other. He just goes with the facts and with the data. And he's not afraid to share. And so we're going to have like just a unplugged hour. If you guys have questions about the next, 12 to 18 to 24 months in real estate, bring your questions. He'll answer them. As of to what he thinks, but I'm a huge fan. I like him a lot. And so I am pumped to have him on September 26th. So you can click the link. We'll email this out too for those of you that are driving, just so you can have it. But highly encourage you to be on, invite a friend. Anybody's welcome. You don't have to be with us or with KW or whatever. Just hop on and learn from him. I believe in collaboration over competition. And if you aren't following him, you should go follow him on Instagram, Jared James. Watch some of his reels. He puts out very real, authentic information, and it's all factual, which is what I love. So hope this was helpful. Any questions, or did you guys get some stuff out of today? Hopefully so. Awesome. Okay. Well, as always, if you need anything, thanks for being on, Annabelle. Thank you, Ruth. Thank you, Wendy. Anything you guys need, or if I can help answer any questions, I might not have all the answers, but I'll find them for you. Just please let me know. We'll email out all of the things from today too. And I hope to see you on September 26th with Jared. Bring your questions, and he's got big energy, so be ready. Have an awesome rest of your week. I leave for the US Open tomorrow in New York for the weekend, so super pumped about that. Then I'll be back to work next week. So see you guys. Have a great rest of your week. Thank you. See you.